For the first time in nearly 3 years, homebuyers finally got some good news. After months of watching rates climb and affordability slip further out of reach, a long-awaited shift has arrived. Mortgage rates have dropped below 6%, breaking a psychological barrier that has loomed over the housing market for what feels like an eternity to many would-be buyers. On January 9, 2026, the average 30-year fixed mortgage rate fell to 5.99%, the lowest since early 2023. This marks a significant milestone, as rates haven't dipped this low in almost 3 years, offering a glimmer of hope to those who have been waiting on the sidelines. This sudden, dramatic drop wasn't a slow market shift, but a direct response to a major policy announcement. The news sent shockwaves through the financial world, catching many experts and analysts off guard. Just a day earlier, rates were at 6.21%. The overnight plunge was swift and unexpected, leaving both lenders and borrowers scrambling to adjust to the new reality. A drop of over 0.2 of a point overnight is rare and signals a powerful force at work. Such a dramatic shift is often the result of significant economic intervention or a major change in market sentiment. In this case, the Federal Reserve's unexpected announcement to pause rate hikes and signal a more dovish stance on future policy sent immediate ripples through the mortgage market. Investors responded quickly, driving down yields and, in turn, mortgage rates. For many Americans sidelined by high borrowing costs, this is the first real sign of hope in a tough housing market. Families who had put their dreams on hold are now dusting off their plans and reconsidering their options. The 6% barrier has been a psychological and financial roadblock for months, keeping buyers on the sidelines. Many felt locked out, unable to afford monthly payments that had soared alongside rates. With rates now below that threshold, the math changes for millions of households. Lower rates mean lower monthly payments, making homeownership more attainable for first-time buyers and those looking to move up. Now, with rates dipping below that threshold, millions may reconsider homeownership. Real estate agents are already reporting a surge in inquiries and renewed interest from buyers who had previously stepped back. This single event has reshaped the landscape for the spring buying season, injecting new optimism and urgency. Sellers are preparing for increased activity, and buyers are eager to take advantage of the improved affordability before rates potentially rise again. Lenders, too, are bracing for a wave of new applications, as more people rush to lock in these lower rates. The entire industry is buzzing with anticipation, hoping this momentum will carry through the year. For the first time in years, the door to homeownership is opening wider for American families. With rates finally below 6%, the dream of owning a home feels possible again for millions across the country. The catalyst? A late-night post from President Trump on Truth Social. He announced a $200 billion government purchase of mortgage-backed securities, aiming to drive mortgage rates and monthly payments down. This bold move bypassed traditional policy channels, delivering immediate impact. The president's directive was quickly confirmed by federal officials, and the first $3 billion in purchases happened by Friday morning. Bill Pult, head of the Federal Housing Finance Agency, responded publicly, "We are on it, Mr. President." This rapid, unconventional approach is a hallmark of the current administration, acting fast to deliver results voters can feel. While some questioned the president's authority, the market's reaction was swift and undeniable. Why did rates fall so fast? It's all about mortgage bonds. When the government buys billions in mortgage-backed securities, demand surges, prices rise, and interest rates drop. Lenders can now sell loans for more, so they don't need to charge borrowers as much interest. This targeted, massive purchase is a textbook case of quantitative easing, focused solely on making home loans cheaper. The result? A rapid, market-wide reduction in mortgage rates. It's a direct, powerful lever to lower costs for homebuyers almost overnight. Fannie Mae and Freddie Mac, America's housing finance giants, are at the center of a sweeping new initiative, executing a massive $200 billion purchase of mortgage-backed securities. These two institutions, often called the backbone of the U.S. housing market, play a crucial role in making homeownership possible for millions of Americans. Their actions ripple through the entire economy, affecting everything from interest rates to the stability of local communities. Since the financial crisis of 2008, Fannie Mae and Freddie Mac have operated under federal conservatorship, meaning the government has overseen their operations to ensure stability and affordability in the mortgage market. Their mission? To keep mortgages accessible and affordable, especially during times of economic uncertainty. This federal oversight has shaped their every move for over a decade, making them key players in national housing policy. Now, with this new directive, Fannie and Freddie are nearly doubling their holdings, deploying their substantial cash reserves to purchase more loans and securities. This immediate injection of capital is designed to stabilize the market, encourage lending, and provide a safety net for both lenders and borrowers. The scale and speed of this move are unprecedented in recent years. Federal Housing Finance Agency Director Bill Pult confirmed that these purchases began within hours of the announcement, highlighting the urgency and efficiency of the operation. The FHFA's swift action signals just how seriously the government is taking the challenge of keeping the housing market afloat. By stepping in as major buyers, Fannie Mae and Freddie Mac are ensuring that every dollar invested directly supports home loan affordability. This means more families can qualify for mortgages, more people can buy homes, and the dream of homeownership remains within reach for millions. However, this bold move has reignited a long-standing debate in Washington and on Wall Street about the future of these housing giants. Should they remain under government control, be privatized, or transformed into public utilities? Lawmakers, economists, and industry experts are weighing the risks and rewards of each option, knowing that the outcome will shape the housing market for generations. For now, though, their mission is clear: drive down mortgage rates, support the housing market, and help American families achieve the stability and security that comes with owning a home. With the government deploying its biggest tools, the goal is simple but ambitious: make homeownership more accessible and affordable for everyone, ensuring that the American dream remains alive for generations to come. At first glance, a drop in mortgage rates from 6.21% to 5.99% might not seem like a huge difference. But when it comes to your finances, even a small shift in rates can have a significant impact on your monthly budget and long-term savings. Lower rates mean you pay less interest over the life of your loan, freeing up money for other priorities, whether that's saving for college, investing, or simply enjoying life a little more. For example, on a $400,000 30-year fixed mortgage, your monthly payment drops from about $2,452 to $2,396. That's a $56 monthly savings, money that stays in your pocket instead of going to the bank. While $56 may not sound like much, it adds up quickly. Over the course of a year, you'd save $672. Stretch that out over the full 30-year term, and you're looking at more than $20,000 in total savings. That's enough for a new car, a major home renovation, or a substantial boost to your retirement fund. For families, these savings can make homeownership more manageable and less stressful. Lower monthly payments mean more breathing room in your budget, making it easier to handle unexpected expenses or plan for the future. Financial analysts estimate that for every quarter-point drop in mortgage rates, homeowners can save up to $70 per month on a typical loan. That's a meaningful difference, especially for first-time buyers or those stretching to afford their dream home. If rates continue to fall, the benefits only grow. Lower rates can encourage more people to enter the housing market, increasing demand and giving buyers more confidence to make a move. And it's not just 30-year loans that are affected. 15-year fixed rates have also dropped, giving buyers more flexibility and options to choose a loan that fits their needs and financial goals. With lower rates, more people can qualify for mortgages, and a wider range of loan products becomes attractive. This opens the door for a more diverse group of buyers and helps more families achieve the dream of homeownership. In short, this broad-based drop in mortgage rates is a true game-changer for affordability, making it easier for more people to buy, own, and enjoy their homes. The president's move sent mortgage lender stocks soaring. Investors rushed to buy shares, betting on a surge in new loans and refinancing. Rocket companies jumped over 9%, UWM Holdings soared 13%, and PennyMac rose 6%. Wall Street sees this as a clear boost for the mortgage industry's future earnings. Lower rates mean more buyers and more refinancing, translating to higher profits for lenders. A healthy, profitable mortgage sector is key to a functioning housing market. When lenders compete, borrowers win with better rates and terms. The stock surge signals strong confidence that this plan will work. Experts agree, rates are likely to fall further as the $200 billion is deployed. Some predict 30-year rates could reach 5.25% by year's end, saving homeowners hundreds more each month. Others caution the impact may be more modest, given ongoing housing shortages. The ultimate effect depends on how quickly the funds are spent and broader economic trends. Still, the direction is clear: downward. For buyers, this is a rare window of opportunity. The program sets a ceiling on rates and a path to greater affordability. Whether the drop is modest or dramatic, borrowers are in a better position than they've been in years. This $200 billion intervention is a direct attack on America's housing affordability crisis. While it doesn't build new homes, it slashes borrowing costs, making monthly payments more manageable. The U.S. faces a shortage of 4 million homes, keeping prices high even as rates fall. The administration's move recognizes that waiting for the market to fix itself isn't an option. This targeted bond buying program delivers relief directly to homebuyers, bypassing slow-moving economic forces. Long-term, solving the crisis means building more homes and keeping financing affordable. For now, this is the most significant step toward rebalancing the market in years. For would-be buyers, this is a golden opportunity. Sub-6% rates make home ownership more affordable than it's been in years. Buyers who were waiting on the sidelines now have a real reason to act. Experts predict rates could fall even further, keeping the market competitive through the busy season. Lower rates may also encourage existing homeowners to sell, easing the inventory crunch. The landscape has shifted in favor of buyers: more homes, lower rates, and better deals. If you've been waiting, now's the time to get pre-approved and start your search. The path to homeownership is clearer and more affordable than it's been in a long time.